battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office for the past 43 long years. It's been our mission to deliver both clarity and confidence to help secure your financial future. We are back. It's episode 146. Hard to believe we are rolling right into April. It's already April. Can't believe it. The year is flying by. 2 weeks from now, we've got our two big events coming up. Gibson's and Oak Brook on the 17th. We're at max capacity now for Oak Brook. We'll see you there. Thank you for registering. Can't wait to see you. A week after that, April 24th, True Looks in the Woodlands at max capacity down there. Two sold-out events back-to-back. Can't wait to be down there to give you the clarity and confidence. You're going to see the whole team. You're going to see the group. We're doing a live podcast on stage on the 17th. Can't wait. And then True Looks on the 24th. We'll see you soon. We got producer Owen. We got the crystal ball. We are back. Bigger and better than ever before. We are talking about the stock market. We're talking about the economy, giving you the reasons, math, statistics, why you got to stay on your plan and not panic. We do know that there's a time coming, quickly approaching, in my opinion, where there will be a correction in the market. And everybody's saying, Nick, you think there's a correction coming? When is that correction going to happen? So what I do is I go to the crystal ball, and it is very heavy. It is crystal. It is telling us what's going to happen. It's a little cloudy, not telling us too much. But if I had to guess and I go to the crystal ball, I would say most likely we are overdue for a correction, and we should see one later this summer or maybe even fall. So when that correction happens, you've got to distinguish between the narrative and the data, math, and statistics and the fundamentals behind the market. Fundamentals versus narrative. Those are the two driving stories. And if you buy into the narrative and you listen to CNBC and you watch these people shouting about how the world's coming to an end and these doom and gloomers, and then you watch the ads, the advertisements, the TV commercials are even worse, even more scary than the actual people on TV, on CNBC, then you may buy the narrative, you may sell your stocks and panic and never return back to the equity market, the best hedge against inflation over time. And so that is why I tell you, you've got to know what's going on. And what I'm going to do in this article, I'm going to just tell you, I do think there's a correction coming. No, I don't think the world's coming to an end. I don't think the sky is falling. I don't think you should go build a bunker in your backyard and fill it with canned food. I think you should stay on your plan. I do think the stock market's going to be just fine in the long run. But all that to say, I'm going to give you a couple of solid reasons. I would call it a few pillars of what the economy is standing on. And it's not just standing on a fugazi, woozy, wazi. It's not just built on sand. It's built on a firm foundation, which is consumers, which is businesses, which is record stockpiles of cash, which is the fact that companies are still very profitable, that people are still in better shape than they were 10 years ago, and that companies over time, thanks to technology, thanks to innovation, thanks to entrepreneurship in general, over time are going to be fine. And so you've got to keep an eye on technology. You've got to keep an eye on the stories of entrepreneurs. And that's why I've told you, look at what Elon Musk is doing. You can love the guy. You can hate the guy. You can think he should have bought Twitter or not bought Twitter. Maybe you're never going to buy a Tesla. You're never going to buy an electric car yourself. Fine. I'm not going to probably buy one anytime soon either. But the bottom line is you have to just be astounded by what he's doing at Tesla. And it should amaze you the level of technology and innovation that's gone on. Look at NVIDIA and what's going on with the AI boom. And I know some of the AI stuff. I've been on the front edge of saying that a lot of the AI stuff is a bubble, and you got to be a little bit careful with some of these stocks. But NVIDIA, in my opinion, not telling you to go buy it or sell it, not a recommendation on what you should do with your money, just general commentary here saying that NVIDIA is a very strong company. It's not built on sand. It's not a fugazi. It's a real operating business. And I just named a couple of names here, but you can extrapolate that across the entire stock market. You can identify companies that are in great shape. You can identify companies that are a disaster. You're going to try and avoid the disasters if you can. I've said that Walgreens, I thought, was going to be a big problem. We did a show last year, and we published a little clip on YouTube in January from that episode that was earlier last year. Walgreens has a cash problem. And again, not telling you to short Walgreens stock, but there's a difference in operating models between some of these legacy businesses that have been around for 100 years and the up-and-coming companies that are really producing a lot of cash and taking us into the next age of innovation. And as long as you stay up on that and you know the stories and you understand what the entrepreneurs are doing, I would encourage you, subscribe to a couple of those science and technology magazines. Find out what's going on underneath the surface, because you're going to hear some incredible stories of what technology is doing. And it's not just to bolster profits, which is a byproduct of what entrepreneurs do. It's also to make the world a better place. That's why I've told you the U.S. is the best place to be. Why? Because of the rule of law and personal property rights. The fact that our entrepreneurs, our people here, get out of bed in the morning and know that if they create and innovate and build a business and grow their net worth over time, that they get to keep that net worth, that that's theirs, that they can pass down according to their wishes. And so that's why I continue to tell you, you got to know the fundamentals. You got to know how the economy really works. You got to know how business works. You got to know what human nature is. All that stuff piles on top of each other and leads to either communism, where people are destitute and poor, living in abject poverty like they are in China, or it leads to the most wealth the world has ever seen, which is the United States. And so I'm going to continue to say this. You may not like this. Maybe you don't like me for saying this, and that's okay. But I believe that the U.S. is the last and best hope on earth still. And I believe that our entrepreneurs are going to continue out-innovating, out-producing, and outgrowing any other entrepreneurs on earth. And it's not just to say that the Chinese people aren't smart or the Japanese people aren't smart or anything like that, but all of the best Chinese, all the smartest and top Japanese, the top Europeans, the top Indians, the top Africans have come here. And this is a melting pot of one thing, and that's ideas. Ideas are what power the economy forward. So as long as you hold on to these stories and you believe in that story that the U.S. is the last and best hope, it's the place that my grandmother came through, Ellis Island, in search of a better life, escaping the Nazis from Hungary. You may have a similar story in your family, how your great-grandma or your grandma or grandfather came into the United States in search of a better life. You see the people on the life rafts coming from Cuba across shark-infested waters to try and get into the port of Miami. Why? Because this is the place where at the end of your life, you pass down your money according to your wishes. So that's what we are doing here. That's what we're trying to talk about. I just want to set the stage for why you have to know what's going on, because when that correction comes, these are the facts that you have to cling to so that you are still an optimist. There's a couple big things that I think are driving the economy forward. They've driven the economy for the past 100 years, but even more so the next 100, I think are going to be long-run structural forces that will power markets forward for the long run. Number one, we have an aging baby boomer population. It's estimated that approximately 10,000 baby boomers will retire per day in the United States. Baby boomers just naturally hold most of the wealth because of long-term compounding. Obviously, the older generations have been in the markets longer. They've been invested for a longer amount of time. And so because of that, they have the highest average net worth of 1.2 million. We see this every day. Baby boomers retiring, we're helping them. We're doing a financial plan, a retirement plan. And as soon as they retire, they're not sitting at home. They're doing the opposite. They're going out and they're spending money. And so retirements are a positive for the economy. Baby boomers are paying down debt faster than everybody else is doing. A lot of them don't even have mortgages. A lot of the baby boomers that we run into don't have debt. And so they're spending that money on luxury goods. I tend to think that luxury goods are going to be a huge benefactor of the baby boom wave that we're living in. Even further than that, UBS publishes this study, and so does Merrill Lynch, that over $4 trillion is set to be passed between generations during this thing called the Great Wealth Transfer. Starting this year, going through the year 2045, we see this all the time. Inheritance money is usually spent on second homes and new cars and other luxury goods. You've seen Ferrari stock just take off the past 5 years, 10 years. You've seen LVMH, Louis Vuitton just take off. All these companies are in that luxury goods space. Look at the home manufacturers, a positive for markets that inheritance money is being passed down, that money is being spent by baby boomers. So this is a structural force that you cannot slow down. It's naturally built into our economy. That's number one. The aging baby boomer population, I believe, is going to drive long-term growth. Number two, emerging market wealth explosion. Now, China, which basically got handed to them this favored nation status in the early 2000s, absolutely boomed. Now they're cracking down on the same capitalism that took them to where they're at. I believe other countries are going to benefit from China's crackdown. You're seeing India, which has largely started to say, hey, look at us. We're right here. We got about the same amount of people. We've got all the same infrastructure, but we're not going to throw you in jail if you say something against President Xi. A lot of U.S. companies are coming over to India. They're going to Vietnam. They're going to Pakistan. They're going to Indonesia. Why? Because these places are booming. And we're going to see, I believe, in our lifetimes, this boom in the emerging markets where strong U.S. companies that sell consumer products or are in the technology space are going to just absolutely boom if they know how to properly sell into these markets. Latin America is booming. And as these emerging market countries embrace capitalism, I know it's a dirty word, capitalism, not supposed to say that it's good, capitalism that takes more people out of poverty than anything else, any other system. And I know it's the worst system on earth, except for every other system that's been tried. I think we all can agree we'd much prefer capitalism over communism. As these emerging market countries embrace capitalism at a record pace, they are lifting their people out of poverty. They're making life better. People are living longer. They're having better access to clean water and plumbing and all the basics that we take for granted in the United States. And so because of that, I believe companies who can effectively sell into these regions are going to do just fine. There's a couple of companies that we watch like Amazon, Apple, Citibank, Google, HP, IBM, not recommendations, as you know, to buy or sell, but just companies that have large presences in a large presence in India, for example, that can sell into that market. So that's kind of interesting. I believe is going to be a win for shareholders. That's number two, emerging market wealth explosion. Pillar number three, demand for high quality investments. Hard to believe, but in 1975, only 11% of the American workforce had a defined contribution retirement plan. That's like a 401k that you'd have at work, a 403b, a 457. What happens in a 401k, in a defined contribution plan? You're responsible for contributing to your retirement. Now, you may get a match, so maybe you put 5% in and your employer matches you 5 or 6% or something like that. But then you're also responsible for the investments. In the old school model, way back in the 70s, what would happen is people would be in a defined pension program, a defined benefit program, and that's the opposite of a 401k. That's where you're not responsible for making your own investment decisions. It's a small group of people. What's happened, I believe, is the country has actually become a lot better thanks to defined contribution plans. Because people are paying attention to the stock market more than ever before, they're supporting better policies for companies. They're supporting less taxes. They're supporting less regulation because everybody feels it in their wallet when there's bad policy in Washington. That's what everybody talks about. You got to vote with your pocketbook. And as you see people become more and more wealthy and more successful, and you see millennials leave the lower income groups and go into the upper income groups, what happens is they tend to move more towards the middle of the political spectrum. And that's what we need. We need common sense in Washington. There's a quote, I don't know who said it exactly, but compromise or a good deal, a good compromise is when both sides are unhappy. That's what we want to see, quite frankly. We want to see gridlock in Washington. We want to see neutrality. We want to see politics out of our day-to-day lives. And when you get that, when people become more wealthy, when they're paying taxes, when they're investing in their 401ks, and they know that policy impacts companies, what they do is they tend to be more in the middle politically. And so that will create more wealth too. But the other thing that's happened is Participants in 401k plans, every single paycheck, every month, whatever the contribution rate is they are pummeling hundreds of billions of dollars now into stocks. And a lot of this money is going towards U.S. companies. So we've got all this demand, all this, remember, everything in the economy is supply and demand. If you have a lot of supply and no demand, what happens? Prices fall. If you have a lot of demand and no supply, like COVID, you'll remember what happens? Prices go up. And so stock market and good companies are the same way. There's just not that many fantastic companies out there. Out of a universe, we did this exercise last week, a universe of 8,000 companies, maybe 50 or 100 look worth buying. And so when you have hundreds of billions of dollars in defined contribution and 401k money that's going in just naturally every single paycheck, there's just not that many companies that people can buy. And so what happens to U.S. equity valuations over time is they should rise. And that's what we've seen. I want to point out the fact this is so important for people to understand. All of the doom and gloomers, a lot of their analysis that's gone wrong the past 15 years coming out of 08 and 09, coming out of COVID, coming out of 2022, and even last year to an extent, saying that the world was coming to an end, was all based on that math equation, earnings time price, saying that the valuation on the S&P was going to fall from 20 times earnings back down to like 15, because that's the long-term average, is 15 times earnings on the S&P 500. And that's how you end up with the S&P's level. You take 15, which is the multiple, or 20 like we're at today, and multiply by next year's earnings. And so if next year's earnings are $250 and the valuation multiple is 20 or 22, multiply those two together, that's where you come up with the fair value for the S&P, and then you adjust for interest rates, of course. So a lot of the doom and gloomers said, hey, we're not going to trade the S&P at 20 times earnings. We're going to trade it at 15 like we always have. And I just think that's bad math. It's not good analysis. And the reason it hasn't happened like they said it would, is because there's so much demand for good companies. When you saw all that money leave China the past couple of years during the trade war, during the crackdown, during throwing all these people in prison, all the top billionaires like Jack Ma, who runs Alibaba, what happens is investors get nervous. They say, wait a second, I thought I could invest in these Chinese companies. We never did this, by the way, thank goodness, but a lot of people did. They said, we could invest in these Chinese companies and maybe we'll make a pretty good return here. Well, now you go invest in a Chinese company and you don't even know if the financials are correct or accurate. And so that scares people. It scares sovereign wealth funds. It scares large pension funds. It scares family office money, because what they do is they say, we got to have a consistent, stable, predictable return. Where are you going to go for that? You can't do it in China. The returns in Europe have been a disaster. The only thing working in Japan is the currency. And if you take out the currency in Japan, Japan's done nothing in the past 5 or 10 years. And so you're left with the United States. So you have all these investment dollars chasing a few companies here at home. And that's what's pushed valuations up. Now, should valuations long run be 30, 20, 50, 10? I don't know the answer to that. But if I had to guess, I think 10 years from now, valuations are likely to be higher than they are today. Companies are more valuable. Revenues are more stable. Revenues are more predictable. Earnings quality is better. Free cash flow is better. These companies are more stable. They're not going from quarter to quarter, making $100 billion one quarter, losing $200 billion the next quarter. These companies are pretty predictable. We've moved towards these subscription-based pricing models all across the S&P, which is very high quality earnings, very high quality revenue. And so should companies be worth more? Yeah, I think so. Should they be worth 50 times earnings? Probably not. But could we stay at 20 for a while? Sure. Could we go to 21? Sure. And we're still half of what the S&P was valued at in 1999. And so that's another narrative, is that people say, Nick, we're in this bubble like we were in the 90s. And I'm like, no, we're not. You can't even draw that similarity with a straight face, because the numbers aren't there. And you just, again, got to go back to the math. The math says that stocks today are fairly valued, maybe just a touch, 1 or 2% overvalued, like I said a couple of weeks ago, but they're not radically overvalued. They're not undervalued like they were in 2022. We will get to undervalued at some point when a correction happens, and that's when you take your money and you buy like there's no tomorrow. and you're going to get some stocks on the cheap. And then the companies that have higher PE multiples will correct more than the broad market. And maybe there's a few that you've been looking at that you've wanted to purchase, and that's when you buy them. So that's number 3. Demand for high quality investments doesn't seem like it's going away. And I think that's a trend that will continue and power stock prices higher. Last thing, and I could do 10 pillars, quite frankly, but I'll just finish with number 4 for our purposes today. And that's that there's record stockpiles of cash on the sidelines. There's all these people that are doom and gloom and nervous. Morningstar reported that at the end of 2023, there was roughly $6 trillion, $6 trillion with a T dollars in money markets and cash on the sidelines. Why? And by the way, it's a record all-time high. But why? Because people are nervous. People are scared. They're worried the world's coming to an end. And everybody feels this way. If you talk to your neighbor, you talk to your cousin, your friend, your brother, your uncle, whoever, and you ask them, what do you think's going to happen with the economy? Oh, I don't know. And now they may say, I don't think the market's going to fall apart. I don't think the economy's going to fall apart. But it's what? It's uncertainty. And there's a whole lot of companies and corporations and management teams that run these corporations that feel the exact same way. These are just people. I mean, we have some of these people as clients. We have high-level executives. We have VPs of large Fortune 500 companies. I talk to them. They're just regular people. They put their pants on in the morning the same way you and I do. And they feel the same fear that we do in our own portfolio, but then they're affecting a large balance sheet or a large income statement at a company. And when they're nervous, what do? They do what we do. They start to doomsday prep a little bit. They get a little bit worried. They cut back a little bit. They don't expand aggressively. Why? Because they're waiting to see what happens in a lot of cases with interest rates. They don't want to make any dumb decisions here and overexpand when rates are 7, 8, 9% for companies. And all of that uncertainty, all that doomsday prepping has led to this stockpile of cash that eventually is going to have to go somewhere. And you go, Nick, how do you know that? Well, yes, you're getting 5.25 or 5.1 or maybe even 5.5% on a treasury right now to hold short-term money. That's great. That's fine. That's good for now. But at some point, the Fed will cut interest rates. I don't know if it's going to be this year. I tend to doubt that. And I have warned you, don't buy long-term bonds yet because we may not get the cuts that the bond market thinks is coming this year. Let's say it's 2025. Maybe it's 2026 when we get some significant rate cuts. At some point, that cash is not going to yield 5% anymore. It's going to go back to reality. It's going to go to 4. It's going to go to 3, maybe even 2.5. And when that happens, a dividend on an S&P 500 company at 2.5%, plus the potential of price appreciation where you could get 5-6% in growth on top of the dividend. Now you're looking real return on S&P, maybe 7%, 8%, maybe 9% on a tech company. People are going to say 9% is a lot better than the 2.5 or 3% that I'm now getting on my treasuries. I've got to get my cash to work. And look, you may be sitting on 50 grand at the bank, 100 grand in the bank, and that's a lot of money. That adds up quick. But it's more so the companies that are sitting on record stockpiles of cash. Apple's sitting on $100 billion in cash. You got Berkshire Hathaway sitting on like $170 billion or something like that. I can't remember the exact number that just came out. But these companies that are sitting on more cash than most countries' GDPs are making more in interest risk-free now than a lot of mid-cap companies even do in revenue. Let that really sink in for a second. There's so much stinking money out there that's going to come into the market, and it's going to push stock values higher. And I actually think that will dampen or it'll lessen the potential of a correction that's coming later this year. There's a lot of people waiting for a buying opportunity. So just stay patient. Again, we're at 52 or 5,300 points here, depending on when you're watching this show on the S&P. And I believe we're going to have a 10 or 15% drawdown. So that's going to take us maybe in the 44 or 4,500 point zone. And then we're going to recover. We're going to go back up, I believe, by the end of the year, or early next year, to record all-time highs again. So what are you going to do? I mean, what could you possibly do to react to that? You're telling me you're going to sell today, okay? Then you're going to wait till 4,500 on the S&P. And then you're going to be quick enough and smart enough to react and get back in at 45 and catch the bottom perfectly and then get right back to all-time highs again and make a bunch of money and short and buy. Maybe you could time it perfectly, but it's very hard to replicate that consistently over time. And that's why I've said just be on a goals-based plan, have some money on the sidelines, have some cash if you're retired, enough to get you through a correction so you don't have to sell your stocks when the market's going down. And then when the markets go back up, you'll be happy you just stayed the course. It's so much easier that way. It's going to cost you a whole lot less in taxes and all the rest of it to get out of the market and get back in. So just stay on your plan. We've got plenty to be positive about. We've got plenty to be optimistic about. There are so many good things going on if you open your eyes and you look for them. Yes, there's some doom and gloom out there. Yes, there's some downside. I'll just give you a little example of this, though, of how companies operate, how managers or VPs or CEOs operate. So I have a client who runs small businesses. He's very successful. And we went into the end of last year saying, what do you think next year is going to be like? Because I love to hear from our business owners. What do you think? Because we get real-time data from them. He goes, Nick, I think we're going to be down about 10% next year. I think we're going to have a significant slowdown. We're already seeing some weakness with consumer. I think we're going to be down 10%. Well, we just got done with the first quarter about a week ago. And I saw him. I asked him, I said, how was the first quarter? Were you down 10%? And he said, no, we were only down 1.5%. Go, what about the 10% you said you thought you'd be down? Yeah, it wasn't as bad as we thought. But what had he done all that time, or what had he done for the past couple months leading up to what he thought was going to be a big drawdown? He was doomsday prepping. He was stockpiling cash. He was saving. He was maybe trimming some off where he didn't need. And he was getting ready for that downturn he thought was coming. It was a tenth of what he thought. And that, I believe, is where a lot of people are just overestimating what Jamie Dimon, CEO of JP Morgan, would call an economic hurricane. And we love Jamie Dimon. I think he's great. I think he's a great leader. I think he's done a phenomenal job, one of our best performers in the portfolio, JP Morgan stock. So not saying anything about him personally, but he is paid to be a risk manager. He's the face of the largest bank in the United States. He is in charge of trillions of dollars in assets. And so he is paid and rewarded to be a risk manager, which he is. He successfully avoided a lot of the bad loans that the regionals took on during COVID. And that's why JP Morgan's done well. That's why they've acquired all these small banks that have been struggling. And so that's a positive if you're an equity investor. It's just that if you pay attention to this too much in the media and you put too much stock into what these guys are saying or these people are saying on CNBC, what happens is you can get a little bit too bearish when what they're doing is they're just doing the rational thing. They're preparing for a downturn in case it comes. So that's where I'll leave it. Stay the course. Since 1900, so going back 124 years now, the S&P 500 has returned 9.81% per year, effectively beating inflation by 6.86% per year. Inflation is right around 3% since 1900. Problem is, the market doesn't go up in a straight line forever. And if you want the liquidity, the transparency, and the inflation beating power that the stock market can offer, you have to pay the price. Volatility. There's no such thing as a free lunch. You're not going to get the great returns the stock market offers, the transparency, the liquidity it gives you, unless you're willing to accept volatility. It's not risk, it's volatility. Risk is different than volatility. Risk is that you run out of money in retirement because of the rising cost of goods and services. It's because inflation goes up 3% a year. That's your risk. Volatility is simply the market going up and down. And if you can stomach that, if you need some help stomaching it, you call an advisor like ourselves, you give us a call, we get you going on a financial plan, or you hire another good fiduciary advisor you trust. Stocks, I believe, will be your best hedge against inflation over the long run. So stay the course, stay bullish, stay optimistic, tune in to Bullish. It's coming up. We're actually going to record it right after we get done with this show, Sam Hardy and myself. We don't have a guest this time, but next episode after this one, we will have a guest. You got to tune in. So watch Bullish. It'll come out later this week. And then we do have a guest coming into the office, Dave McGarrell, the Chief Investment Officer of First Trust Portfolios, a leading asset manager in Wheaton, Illinois. Just absolutely a wonderful firm. They've done a great job over the years. great partner of ours, Dave McGarrell, CIO of First Trust, coming in for a podcast interview with us on, I believe it's going to be April 8th. So stay tuned. Watch Bullish if you haven't already. And then we'll see you April 17th. We got Jeremy Schwartz doing a live podcast on stage with him. Week after that, we'll see you in Houston. Thanks for being on episode 145. We'll see you. Oh, I'm sorry. This is episode 146. We'll see you next episode 147.